next guest says after gaining for 5 weeks in a row, maybe now's the time that the markets will head in the other direction. Let's bring in Tyler Vernon, a principal from Biltmore Capital Advisors with more. Tyler, to your credit, you said the markets would rally at the end of the year. They did. They would sell off and hit new lows. They did. You said they would rally in the month of March. They did. So where now? Lower.
I think they need to go lower, Dagan. Here we're sitting in, we've had 5 weeks of the best run-up since 1938. Above and beyond that, 84% of stocks out there are trading well above their 50-day moving averages. Typically, when we see a sustained rally, we'll see some sort of step function as far as the charts. And at this point, we've just had a huge run-up. So I think people that are buying in at this point are thinking that we need to have a very strong recovery over the next few months, and we just don't see that happening. We think as these earnings continue to come out here over the next few weeks, we're going to see some disappointment when it comes to outlook. So I think we need to be trading down here. I would not be buying in. I'd be taking profits at this point.
But we have the president. We've got the Fed chairman making comments. Goldman Sachs coming out with a big quarter. Why not? Seems like there's some, what did Bernanke call them, green shoots out there.
Yeah, well, we look at a report that came out last week. It was a report from CEOs and their confidence. And what it showed was that some of these numbers are at record lows. So I think investors right now, they're not necessarily looking at the numbers from last quarter. They want to see what CEOs are looking at over the next quarter and in the future. Or have we turned that corner? And I think what they're going to see is more and more CEOs a little bit less optimistic than the market would suggest.
But what about consumers maybe being a little bit more optimistic? Tax refunds are up, what, 15%? Yep. You have the tax breaks and the stimulus package. You have unemployment benefits being paid out. Brian,
$7 a week per worker in a tax break. Meantime, the states are going to hit everybody more than that.
Yeah. Well, here, you stole my thunder.
Did you think that?
Yeah.
Well, we live in the same area, so we know how high we get taxed. So.
Well, no, I agree with you. I think here's what we're going to see. You're right. Well, first of all, some of Bush's last stimulus, the effects of that are stopping here. We're seeing some record refunds come through. So I think it certainly will help. But what we have really on the fundamental spending side, we don't think a recovery is going to happen until this consumer starts getting back into the market. Savings rates have gone from 0 to 6%. We see that continuing to go higher. Bankruptcies are sparking up, please.
Okay, so the savings rate's going up, but what if that savings winds up in the stock market? Because, again, what you're getting on CDs is so low. What you're making in a money market account is so low. Yeah. So that could be great for the market.
It could be. I don't see a lot of individual investors getting it. I think a lot of people are really saving. They're putting aside for a rainy day. They're wondering, am I going to have a job in 6 months? So I think this is true savings, putting it in a bank account, getting low yields, and hoping that money is going to be there if people are laid off as we go forward.
Well, we got some. I was looking down, folks. Sorry about that, because I got some breaking news on the economy crossing from the EIA, the Energy Information Administration. Not sure why they're commenting on the economy, but it's relevant to our discussion. Headlines crossing from Reuters right now that GDP is expected to begin increasing in October of this year versus the EIA's earlier forecast of July, and that non-farm employment not seen increasing until April of 2010, 3 months later. So basically the EIA, for the energy side, pushing back their expectations of both economic and job growth for the overall economy. That news crossing as we speak.
Well, this is what we've seen. We've seen, 6-7 months of continued lower guidance, whether it's earnings, whether it's fundamental numbers.
Now it's a government agency lowering their own guidance.
Yeah, exactly. So I think, we've called this the whole time. This is one of the reasons why we thought the markets would continue to go lower. And I think we'll continue to see new news like this. We're going to continue to see less optimism when it comes to outlooks for 09. And I think, again, this market has to retreat from here.
What do you own, then?
Well, I think...
or buy.
Okay. Well, first of all, a lot of what we do is we look for strategies. So we look for managers that are going to do very well in this kind of market. So I think trading strategies are going to make a lot more sense in this market. We've found great traders. I mean, just guys.
Well,
we think CTAs are a great way to go about it. CTAs were up, last year, managed futures, and we think that's one thing that's going to take place are trends in the marketplace. So I think as the trend, whether it's markets down, markets up, whether it's interest rates, whether it's commodities, I think that'll make a lot of sense.
I don't know, but good traders turn into bad traders like that before you even know it.
Well,
but but what about sector allocations or asset class allocation?
Yeah, well, growth has certainly been outperforming value. We would be very cautious getting into the markets. As it continues to trade down, we would be getting in. There's a lot of different sectors that are going to be benefited from Obama's stimulus package. So, Brian, we've discussed this, before. Ingersoll Rand, a lot of infrastructure type of companies are going to benefit from this $40 billion of infrastructure.
So look at some states like Nebraska have already begun work on the roads. Fox News, we showed that bridge in Missouri. I mean, you got to have a gear, you got to have the lighting, you got to have the asphalt. So we've had companies like Ingersoll Rand, Martin Marietta, Vulcan Materials, been recommended by Catherine Thompson of Avondale Partners. Sounds like you think kind of the same way. Yeah,
we do. Although, again, we would be getting in there as the market continued to trade down. I know we continue to get back to this this corporate bond play. We think there's a lot more value now in lower grade corporate bonds. With the spreads have already come in higher grade. So we think BBB, corporate bonds are a great play as a trade, not a long-term hold, but as a trade.
Right, because how can you, I know you dislike treasuries, but how can you dislike treasuries and like corporate bonds? Because, again, if yields go up on treasuries, you're going to lose price. You're going to lose in the price on the treasuries and the corporate bonds, maybe.
We like it as a trade. We like shorter-term, corporates, and we like it, again, as a trade. We think long-term, the treasury is in a bubble. We think there's a lot of reasons why short treasury is a great trade as well. China's stance, inflation play, and the Fed can't keep buying 10-year treasuries forever, keeping these yields down. So I think...
Never say never, Tyler.
Well, my opinion. Consult your advisors on everything we've talked about.
Zimbabwe keeps printing money.
Yeah, it's true.
Look where it's got them.
Yep. Tyler, it's great to see you.
Thank
you so much, Tyler Vernon of Biltmore Capital Advisors. We'll see you soon.
Thank you.
And hold you to it. Let's hope you're right.
All right, let's hope that there is a finite limit of money out there.